Why are the markets so reluctant to believe that March is still a possibility? Is it the Trump unknown? And if we do get actually a lot more detail from the president, will those hike probabilities go up quite fast?
Well, I mean, the big story here is that the Fed has kind of deserves what they're getting by their lack of willingness to keep short part of the curve where it should be based on the economics. So they don't believe the Fed because the Fed has cried wolf too many times. I think it's actually really important that the Fed does get on with this process. Not interest rates, but inflation expectations are rising. The labor market is tight. The Fed needs to move higher. Whether they move in March or June or May, they're going to be moving to try to get ahead of this or back on top of this story. And the market would be surprised if it's in March, but it really doesn't matter. They need to start getting this along.
Right, but Jonathan, if they delay too much, is there not a concern that then they'll have to hike a lot quicker, and that would be disadvantageous for a lot of American households?
They're going to have to raise more than everyone thinks over the next year or 2 years. The rate right now between 50 and 75 basis points is absurd when you consider that wages are going up at 2.5 or 3%. So the Fed, whether they move in March, is really academic. The real issue here is that they're behind the curve. They've basically told us that by saying that they need to move from 2 times this year to 3. They said it again when they indicated that they're thinking about moving in March.
Right.
So they're moving.
Okay, John, I got a two-part question here. And folks, this chart, bring it up here right now, Anthony. This is on TV Go. Justin Sharp Banner getting this out for you. This is a 2-year yield. This is the lollipop chart. We're here right now. Here's the Trump reflation in here. Here's the March 15th meeting, and we go on. 2 ideas here, John. First of all, we got to get out here to where Yellen walks out the door, which is 2018. How much does this Fed turmoil play into what their policy will be? And then the real question is when does the financial repression end? I see no end to it.
Well, if you look historically, and when I say historically, up till about 10 or 15 years ago, the nominal economy, that's the economy plus inflation, told you where interest rates should be. And the Fed just basically, starting with Greenspan, put in place these policies where the Fed funds was disconnected. We should be moving back towards that, which means you need interest rates up 100, 150 basis points from here, not only at the short end of the curve, but even on the longer end of the curve. And I think ultimately the market is going to drag us there. By the middle of 18, I think that you're going to see interest rates at 3.5 or something.
So, I mean, this is really important, folks. And let's bring it up here. Here's 3% way up here on the 2-year yield. I mean, you're saying, and I guess we're migrating there, but there's not a lot of confidence we get there, is there?
And that's why Janet Yellen can say all she wants about March. Until she's willing to take control of this, the market's not going to believe her.
What does it mean for a stable release of these policies, and will that redound onto your equity market strategy?
Tom, we were talking during the commercial about what this does for savers. I mean, this is really damaging. I think that what the surprise may be is as the Fed renormalizes interest rate policy, it's going to create so much additional confidence with savers and their ability to retire that you may actually get an increase in spending and confidence among consumers. Businesses haven't levered up as much as you would think, given how low interest rates are, because of lack of confidence. So this really could ultimately release the economy to be much more productive if we get interest rates moving in the right direction.